Where the market's going by yours truly. How do I know this? You may ask, how do I know where the stock market's going? How do I, out of anyone, have any idea where the stock market's going to be heading? Five Guys just released a deal. They have a classic combo deal. They're offering a little burger, a little fry, and a drink for only $13.99. Clear recession indicator. No, but in all seriousness, I have no idea. Warren Buffett also has no idea. Nobody knows where the market's going, but this is just based off of pure facts, pure data. We see that the S&P is actually in Stegosaurus right now. So the way that, this technical analysis that we're running on it right now, we can tell that it's actually going to go to prehistoric levels. No, I'm kidding. But we do know that there is a lot of things that we can check, a lot of metrics we can check in the stock market. So the things I'm going to go over in this video, there's four things. Where the markets are going, in my opinion, why they're going in that direction, that's two. What I'm going to do to prepare for this, and then what if I'm wrong? What if I'm wrong and I prepared for something all wrong, and then everything goes the opposite direction of where I think it's going to go? So first off, there's a lot of indicators that show we are actually in a recession. A pre-recession. We're almost in a recession. So I think the market's going to go down. No surprise, if you clicked on this video, you probably already know. And I'm not a bear. I think the market's going to go up over time. I think just right now the market's in a very bad spot. If we look at the Buffett indicator, an indicator that's always been very telling of where the market is going to go, we see, it's also called the Buffett index and the Buffett ratio. What this indicator is the total U.S. stock market value over the GDP of America. So we're looking at right now 217%, which in Buffett's metrics is 217% is 68% or 2.2 standard deviations above the historical trend line, which standard deviations are a lot. And then when you get to two of them, that's that's pretty, humongous, honestly. So that's very big, especially for, the Buffett trend line, because we see right here, it fluctuates very often. And another time where it's been, this high, we see in 2020, pre-pandemic levels, it was this high. We see during the dot-com bubble, it was also this high. So, it's all relative to your time frame, but we do see that a lot of the times when it was really high, it dropped pretty promptly right after, and that's because the stock market also dropped. Theory and data with this, the Buffett indicator, because, you can't just slap Warren's, but, you can just slap Warren Buffett's name on something and say that it makes sense. That is the power that his name holds within the stock market. But I definitely do trust this indicator. Buffett says it's, he called the ratio the best single measure of where valuations stand at any given moment. But Buffett has since walked back on those comments. So today we're going to use multiple indicators to show you why this could be the case. This is another indicator, the Shiller PE ratio. These are some crazy indicators, but they all take a lot of things into account. And we see this one is at levels of 40. This is saying every stock has a PE ratio of 40 in the market, on average, which is insane because that should not be how it is. The stock market every stock should not be worth a 40 times PE. That means that even, let's look at Intel right here. We're saying that Intel INTC, this stock with the PE ratio of negative 7.7, is trading at a 40 PE, like on average. So there's a lot of stocks trading at 100 PEs. This averages out to 40. That shouldn't be the case. So the fact that, also look again, the dot-com bubble was the only other time in the stock market where it's been at 40 or above, which is pretty insane. In 1999, we see that it actually hit 40. And we're about to hit 40 right here. So it hasn't hit 40 since then. It hasn't hit 40 since the dot-com bubble. So the fact that we're about to hit 40 right now is kind of scary. That means that we're trading at valuations of when that happened, which a lot of, a big drop happened during the dot-com bubble. And the crazy thing is, we go to SPY right now, you can't even tell. You can't even tell that the dot-com bubble happened, which is insane because during the time, I'm pretty sure it dropped, almost 40% in a day. They don't even have, basically we see, look at it, it was at what were we at? 152, dropped all the way to around 81. That's a $70 drop. That's almost 50% for the S&P 500, which is insane to happen in, a year or two. I think that's probably where we're heading. I'm not going to lie. It's not what I want to say. I have a lot invested in the stock market. You see right here, we're about to hit 30,000 in the portfolio at 28. And that's not what I want to say, but I do think that we are heading towards levels of that. Because we see the only time that the stock market has reached these levels. Do I think this is an outlying time? No. I don't think this is a time, this is just a lot of indicators that are matching up. Let's also look at the unemployment rate. That's also rising. pretty steadily too. I mean, you see it's just, let's take it to 3 years. We see that's rising just pretty steadily. There's a lot of unemployment going up, and then we see, when the stock market did actually crash in 2020, the employment rate. I mean, this was a pandemic. Nobody could have, predicted that, and nobody saw that coming. So obviously the employment rate skyrocketed, the market dropped, a lot of fear in the economy. But then since then, it seemed like it was pretty, underway. Like people actually were getting jobs again, and the employment rate was regular, around 3%, which is, that's pretty good. But now we're rising a lot. We're actually a whole percentage point above that. I think once we get to the 5% level, that's when it becomes pretty scary. And then another metric. So I have 4 metrics here today for you that are going to show you why I think a recession is imminent. Google AI overview, something that's very helpful. As of mid-October 2025, approximately 1.4 million federal employees are working without pay or have been furloughed due to the U.S. government shutdown. 1.4 million people. That's a lot of people. That's a lot of people that aren't buying Amazon products. That's a lot of people that aren't getting a Fubo subscription. They're not going out to eat at the Cheesecake Factory. They're not depositing money into SoFi Bank. This is a lot of people that work for the government that are not getting paid a dime. This is who we're relying on, increasing our stock prices. They're not getting paid anything. And, that's a bad look on America. It's obviously bad for the economy, but a lot of pay is being withheld for people that would probably spend money on things. I mean, everything at the end of the day, a company goes up from, a transfer in wealth. So Shopify is making money because people are spending money. I mean, people have to spend money on your company for the stock to go up, for the company to succeed. That's how you succeed as a company is, gaining more profit than you are expenses. Are you gaining more revenue than expenses, therefore creating a profit? And there is stocks that deserve to be trading at the PE ratios that they trade at. Like SoFi's growth rates are so good that the stock actually trades at a 53 PE ratio. But that makes sense for SoFi. And then the growth rates are so, they're not as insane on Cake because they don't have the same profit margins. They don't have the same growth in numbers. Their PE ratio is a 16 right now. So it's usually relative to the stock, but we're saying that the whole stock market, as all in all, is a 40 PE ratio right now. That's insane. That means that's what a PE ratio of a fast growing tech company is usually at. Let's look at Apple right here, one of the most innovative companies in the world, has a PE ratio of 38. Where the average PE ratio in the stock market is above Apple right now. If that's not a recession indicator, not a recession, but even a correction, I don't know what is. I mean, the market's due for a correction. And basically, I went over these 3 already. What I'm doing to prepare is what I'm going to go on right now. So what I'm doing to prepare for this is I'm going to hold my long-term, stocks. I'm not going to sell out of Amazon. I'm not going to sell SoFi for the long term. There's a lot of stocks I like for the long term. But some of these smaller, riskier plays, like I'm holding TSLZ, PLTZ, actually, those are, inverses of Tesla and Palantir, which will get hit hard if we do have a recession. But stocks like BBAI, maybe some, a little bit of Honest, Celsius maybe even. There's a lot of Fubo. There's a lot of stocks that are going to get hit hard if we have a recession. Amazon and Google are those stocks that you can probably buy forever and be okay holding. Same thing with Shopify. AMD, almost, not so much. ELF, I think so. So there's some bigger holds that I have that I'm going to hold forever. I'm going to just buy more and dollar cost average down if the stock market does go down. But I do want to raise my cash position to around 20 to 30%. I think this is the sweet spot to have your cash at a recession. You want to have 20 to 30% of your portfolio in cash. No more than that, because if it's not a recession, which it could equally be not a recession, I could be completely wrong right now, which would make sense. Why not? Then obviously, you wouldn't want to be holding 20 to 30% in cash while the stock market is up 20 to 30%, because then you missed out. Like, for example, if I have $28,000 in my portfolio, I take 20% out, that's $5,600, and I missed out on a 20% gain. That's 500, that's a thousand something dollars I missed out on. So that would not be ideal. I definitely would feel, left out of that. But then what a lot of people do is then they chase it, and then the market drops. So you're going to, be wrong about it, and then you're going to chase that gain, and then the market drops, and then you're out of your cash position. You're, in for high prices in the market. What are you going to do? So what if I'm wrong? What if I'm wrong on this prediction, which I very well could be? Obviously, why are you going to trust some random dude on YouTube? Because the metrics. I mean, obviously, I showed you guys a lot of ratios right here, and I'm sure you could pull up ratios, going against those that are also right. But I mean, from what I've seen, the research I've done, this is what I believe. You guys don't need to believe this as well. I'm just making this video to inform you guys and give you my opinion. But I think that if I'm wrong, then worst case scenario, I'm selling out of some riskier plays, and then I just get to invest more into these companies that are making money. The worst case scenario is that I make more money. It's really not that bad. I mean, either the stock market drops and I get to dollar cost average in these great companies, or the stock market continues to rise and my positions continue to rise and I continue to get more money. The main thing is that if you are the age of between around 20, maybe 30, 40, if you're not of retirement age yet, or when you want to retire, it's all relative, but if you're not of the age where you want to retire yet, you should want the stock market to go down. You should be happy when the stock market drops. Stock market, in 2022 and 2020, when we were buying heavily, it was down around over 40% or around 40%. And then it rose around 70%, in a year after that. So you could have gained 70% just like that. And 70% of, if you have a decent amount of money laying around, even $10,000, that's $7,000, which is life-changing for a lot of people. And then if you have more money, $100,000, that's $70,000 in a year. That's a salary. There's a lot of things that you can invest in. There's a lot of things you can be right about, a lot of things you can be wrong about in this market. But I think the safe play is to hold some cash, be ready for that recession, but don't hold too much to the point where you're going to miss out on gains if it doesn't happen. Because, it's very political, the stock market right now, especially with the government shutdown, and there's a lot of tariffs. There's a lot of things that are out of our control that could switch, on the flip of a dime. Really anything can happen in the stock market, and we're all just, up to whatever happens on the outside, and we don't really have any say in that. But the best we can do is hold a little bit of cash, be ready for that stock market drop, but also don't, sell all your stocks and go all out and then get back in, when it starts running again. I mean, anything can happen. The stock market could gain 20% before it drops 80. You never know. You never really know. So I just want to make this video to tell you guys to be aware that this is a very possible, this is a big possibility in the stock market. This could happen. It could drop, 40% between now and then a year from today. I think that is probably the most likely situation, is 20 to 30% drop within a year's time from now. Just because, a lot of these stocks are, I don't want to go on and on about this, but a lot of these stocks are just giving recession indicators. We look at ChatGPT and then we look at NVIDIA, who's, providing the most to ChatGPT or OpenAI is buying a lot of NVIDIA chips, and then NVIDIA is putting more money into OpenAI, and it's just a never-ending circle that someone's not making money. And then we see other companies like Klarna. If we look at Klarna right here, we can see that Klarna is actually, this company is not great, but this company is getting a lot of use, and we see it just IPO'd, it just went public. So this company thinks that, something big is going to happen. This is a money borrowing service. People are taking, it's at one of its, highs right now. For it to go public and be a company that big, people borrow money to buy a Chipotle burrito. People will take out, say, oh, let me do 4 months of $2.50 installments to buy this Chipotle burrito with extra guac. If that's not a recession indicator, I don't know what is. There's a lot of people that are, we saw right there, there's 1.4 million people that are working without pay right now. They can't afford a lot of things, and that's not good for the economy, obviously. And the tariffs aren't looking like they're slowing down. There's a lot of things. I could go on for a while, but all in all, within these, 3-4 indicators that we saw today, I think that it's probably imminent that the stock market isn't going to keep rising at the rate it is right now. I can safely say that. And I'd say main thing from this video, if you take away one thing, it's to have 20 to 30% in cash in your portfolio. So that's all I have for today's video, guys. If you did enjoy it, be sure to smash that like button. It helps me out a lot. It's free to you. It's expensive to hold 20% of your portfolio in cash, but it's free to subscribe to me. And also, you can like the video. I really appreciate all the support, guys. 1,000 subscribers. Appreciate you guys so much. We keep on going. New video tomorrow. Peace.